Hello and welcome. Thank you for joining us on Business Incorporated on Channels Television. I'm Chimeze Obi Iwago. On the program today, Libya restarts oil exports at the third port as war abates. South Africa's central bank says rate cuts won't cure the country's skills shortage. And World Bank's IFC adopts new climate rules to deter lenders from backing coal. We'll begin the show with intraday market numbers here in Africa, which were mostly positive. In South Africa, the JSE index surged 1.84%, while Nigeria's main index was marginally higher by 0.05%. Egypt's EGX 30 was the only laggard at intraday by 0.44%. Kenya closed negative on Wednesday. And in the Middle East, major stock markets were in the negative territory except the Qatari index, which rose marginally by 0.01%. Saudi Arabia's main index declined 0.21%. Elsewhere in the region, Dubai's main index shaved off 1.45%, while the Abu Dhabi index lost 0.52%. And in Europe, stocks retreated this morning as investors hope for economic recovery following the coronavirus pandemic falter amid a second wave of cases. There are also other stories getting markets' attention this Thursday. Chelsea will talk to us. Hello, Chelsea. Good afternoon. Well, a new survey out this morning in Germany showed that confidence among businesses picked up in September despite rising coronavirus infections. Has this helped markets recover at all?
It has to some extent. If you see behind me, this is the DAX, and you can see that it has been really paring some of those losses throughout the day. So now it's down just under 0.1%, so really about flat. Today's data from Germany and from German businesses was a bit of a surprise, especially as we've seen a lot of concerns and a lot of data pointing to these concerns about a second wave of infection and about new restrictions coming into place. So this measure of confidence among businesses has increased for another month. It actually was at its highest level since before the coronavirus crisis, so since February. But we are seeing a definite divergence in the economy. So here in Germany and also throughout Europe, the manufacturing sector is holding up quite well, and we saw this reflected in the data today as well. Manufacturers are seeing demand really increase. You're seeing exports increase, but services sectors continue to come under pressure, and this is a trend we've been seeing in data over the past several days. Many services sectors, so things like restaurants, retail, hospitality, all of that is really starting to get hit by these new infections, and that's certainly going to be the case going forward as we see more restrictions put in place.
And JP Morgan says it's moving 200 billion euros from the United Kingdom to Frankfurt as a result of Brexit. Tell us more about this decision.
So this isn't a total surprise. Many banks ahead of the end of this Brexit transition period that ends at the end of this year have started to move some staff into continental Europe. And really the main reason for that is they're facing a lot of uncertainty about what their business dynamics are going to be like after this Brexit transition period expires. A lot of banks had really hoped that the UK and the EU would strike a deal on financial services as part of these trade negotiations, but that's really fallen down the list of priorities. It now looks very unlikely that they will have some sort of agreement on financial services by the end of the year. So for banks, both in the UK and Europe, that means that they could potentially be cut off from some of these markets. It's not guaranteed that, you know, if you're a bank in the UK, that you'll be able to, for example, take business from a client, a company, an investor in the EU after this transition period expires. So for banks in the UK, that means they need to get more people into Europe in case that they start to see their access to the European markets restricted. So we've seen JP Morgan making this move. They're also encouraging about 200 of their staffers to continue to move to continental Europe. And we've seen many other banks doing this as well.
In another development, European airlines have begun offering travelers rapid coronavirus tests as they try to overcome a slump in demand. Can this experiment really work?
It's certainly an incentive, and it takes some of the fear away for people who are considering flying. One of the main reasons that airlines are considering this now is because there are a lot of travel restrictions still in place across Europe, and there are a lot of different travel restrictions based on the country. So it's a very complicated and difficult to navigate web of different rules and regulations. So what these airlines are hoping is that if they allow and if they offer tests to their passengers, that it will make it easier for them to fly, that they may not be facing quarantine regulations whenever they fly into another country. So we've seen this from Alitalia, the Italian national airline. They're going to start offering they're going to start offering some of these rapid antigen tests, which can be done in about 15 minutes to their passengers, both on domestic and international flights. And we've also heard from Lufthansa, which is in talks to begin offering these next month in October. For now, they say they're going to offer them to potentially to first class and business class customers. But for other airlines, it is a potential way to remove some of the complexity and remove some of the fear around traveling, especially as there are so many restrictions still in place that are deterring people from traveling.
Thanks, Chelsea. Well, one day more to go. In the meantime, enjoy the rest of the day. And nearly every stock on the FTSE 100 index fell at the start of trading in London today. Let's see if anything has changed this intraday, and we have Juliana to tell us. Hello, Juliana. Good afternoon. Well, the Office for National Statistics has reported that more than 10% of the UK workforce are on partial or full furlough leave, highlighting the need for more wage support from Rishi Sunak. The Chancellor is to unveil new COVID economic measures today. Wondering if he has spoken yet and what he has to say.
He has spoken, Chimezie. The Chancellor, Rishi Sunak, is still speaking, actually, in the House of Commons, taking questions from opposition benches. And it's a new multi-billion-pound package. I'm sure we're going to be talking about it a lot over the next 6 months. The furlough scheme has been replaced with the job support scheme. Of course, we know there was lots of pressure on the Chancellor to try and expand the scheme, considering we are looking at a tsunami of job losses here in this country over the next few months. So what that means is from the 1st of November, if your employer takes you back to work in this country, the British government will be paying 2/3 of your salary. It will be capped at about £697.92 every month, and your employer must be paying for 1/3 of your wages. Of course, the economists and the media are still scrambling through the details of this. Got to say, it appears as if not many people are happy with this. They don't think it's gone far enough. There were suggestions that the Chancellor would be copying what we've seen in Germany and France, and he is doing so. But he was pretty quick off the mark to say that not every job will be saved, not every business will continue, and he said that and there's no Chancellor that has been or will be coming that will be able to do a job that he is doing. I suppose that's a comment there for his critics. I'll quickly read out something that Sunak did say in front of MPs. He said, "It's now clear, as the Prime Minister and our scientific advisors have said, that for at least the next 6 months, the virus and restrictions are going to impact our lives. Our economy is now likely to undergo a more permanent adjustment." I'll just quickly say some of the other measures that the Chancellor mentioned, apart from the job support scheme, which again, I'm sure tomorrow we'll go into more details on that. The emergency COVID loans, such as the bounce back loan of £5,000 and the coronavirus business interruption loan scheme, you can still apply. There was a date that was coming up soon, but you can apply now to the end of the year. You don't have to pay that loan back within 5 years. It's been extended to 10 years. The VAT holiday for the hospitality and tourism sector will still continue. It's been reduced to 5%. That will continue for a further 6 months. So it will be cheaper to eat and drink bank in the UK. And also self-employment. If you are self-employed, a lot of freelancers were struggling during the pandemic. There will be another scheme in place for you so you can get money for the next 6 months. It's a multi-billion pound package that the Chancellor has been put for people in the UK over the next couple of months. It is going to be expensive. It will be paid back somehow. It's likely to cost the British taxpayer another 10 years of increased tax payments. But there was a lot of pressure, and Rishi Sunak seems to have answered that. But once we've got more details in the morning, I will be discussing it with you, because the job support scheme is likely to be a topic of much discussion here in the UK and elsewhere over the next 6 months, Jimmy.
Absolutely, Juliana. In the meantime, just wondering what the markets are looking at the moment. Is it Sunak's speech or the data talking about retail sales growth, which has hit an 18-month high?
Well, as you said at the top there, the FTSE started off pretty much in the red this morning. It hasn't been great. I think traders are really kind of pricing in now just what these 6 months of restrictions will do to the hospitality sector. The British economy is a service-based economy. 80% of GDP comes from this economy. Tonight, those new restrictions come into place. So from 10 p.m, doors must be shut, which means that they've lost out a lot of their earnings. So the FTSE All-Share at intraday is down 0.39%. The FTSE 100 is down 0.38%. And the FTSE 250, the domestic market, is down 0.20%. In the currencies market, the pound is up on the US dollar by 0.20%, up on the euro by 0.40%, and up on the Japanese yen by 0.28%. It's worth mentioning the retail sales data. The CBI have conducted this survey. They've spoken to about 123 companies, and they have shown that there is an increase in consumer confidence in retail, the biggest increase they've seen since April 2019. But it's really important to mention that the only jump has come in grocers. We know that people are spending more in supermarkets, particularly now in the UK. We spoke yesterday, Chimezie, about panic buying. That's still going on. People are still rushing to get their toilet roll and their hand sanitizer. And also as well, DIY and hardware is up 20%. Sales of clothing, though, really important to note, that's down 40%. Department store sales are also down 23%. As soon as the CBI mentioned that, the FTSE was lower as well.
Well, it's possible people will prefer to eat rather than wear clothes. Anyway, credit rating agency S&P has slashed its economic growth forecast for Britain and warned that a no-deal Brexit will be particularly detrimental. It now expects GDP to contract by almost 10%, followed by a near minus 8% recovery in 2021. This is not surprising, or is it?
It's not surprising. It's very much in line with what we've seen from the British government's own Office for Budget Responsibility. Last week, the Bank of England had their Monetary Policy Committee meeting. And after that meeting, they said that the economy is on par for a 10% contraction this year. KPMG, they believe that GDP in the UK will fall 10.4%. Also, the EU, they believe that Britain's GDP this year will fall by about 8.5%. So between the 8% and the 11% is what we're expecting. In Q2, the GDP here in Britain fell by 20.4%. So at the moment, we are technically in a very deep recession. But there was signs of recovery. In July, GDP grew by 6.6%, lower than expectations, but still does show on a graph, if I had one, that it is a V-shaped recovery potentially. Of course, there are lots of concerns about Brexit. At the moment, Michel Barnier, the chief Brexit negotiator, is here in London for talks with his counterpart, Sir David Frost, Lord David Frost. A no-deal Brexit is still very much on the cards. There are lots of fears for that. But according to the Bank of England Governor Andrew Bailey, COVID-19 dwarfs any possibility of a crippling to the economy of a no-deal Brexit. So at the moment, all economists and all eyes are on how Britain managed to survive a second bout of COVID-19 and not a no-deal Brexit, which is potentially less than 100 days away.
Well, Juliana, for now, we just have to keep digesting Sunak's speech as he's still speaking. Thank you. Enjoy the rest of the day. Well, we'll take a break now. When we come back, we'll look at Dangote Cement's facts behind the figure. Just stay with us.
This is a very important.
Dangote Cement, the most capitalized stock on the Nigerian Stock Exchange, yesterday presented its facts behind the figures and its sustainability plans. Speaking at the virtual meeting, the Chief Executive Officer of Financial Derivatives Company, Mr. Bismarck Rewane, in a presentation tagged Domestic Champion to Continental Behemoth, says Dangote Group has the potential to stave off competition and bite into international market shares. He believes that financial institutions with Pan-African footprint will also benefit from Dangote Cement's success story.
This is not for the faint-hearted. This industry is highly capital intensive. It depends on power and also depends on raw materials. The CFO and the CEO of Dangote Cement have said that. Now, there's fierce competition in an oligopolistic market. You can see the sector growth throughout over the years, and we've already talked about the CAGR of Dangote being 13%. Dangote Cement, in the domestic market, Dangote Cement has 48.6 capacity for 48.6 million metric tons, while the nearest rival, Lafarge, has 10.5 million tons and BUA 8%. So, to all intents and purposes, Dangote Cement is dominant in Nigeria and a leading player in Africa. One of the big challenges for big-time manufacturers and capital-intensive players in Africa is currency convertibility. Luckily, both Nigeria, South Africa, and almost all of these countries are moving towards currency convertibility, and that's a condition precedent for accessing World Bank and IMF facilities. So we are happy to see that, and that gives you a lot of upside as we go on. Dangote has, in fact, you can see from the capital and debt structure that they front-loaded their debt profile at the early stages when interest rates are low, and will take advantage of this in the future. Now, Dangote is, like I said, domestic champion to Continental Behemoth. They've entered a field dominated by multinationals for over 50 years. They've taken leadership and established dominance. The 5-year CAGR, 13%. 5-year GDP growth compared in Africa is 1.24% GDP growth for 5 years, while the CAGR of Dangote is 13%. So it's at least almost 8 times above the GDP growth rate. Free cash flow of 98 billion in Nigeria and a return on capital employed of 26.9%. It's trading at an earning multiple of 11 times, and it has a 70% share of market capitalization. I remember when Dangote was listed by introduction, the Nigerian stock market had lost almost 3 trillion naira after the shock of 2009 and 10. So when they listed with 3 trillion, that helped to restore the market capitalization back to where we started before the crash. So expansion strategy focused in West Africa, 10 countries, and expanding into another 4. The cement export terminals, shifted from self-sufficiency to cement exporter, and I think also to global player. The clinker, the CEO and CFO have already talked about, and it will take advantage of import-dependent nature of most African countries. It will improve its sensitivity to forex risk because they're playing the perfect edge. So largest clinker importers today are China, Philippines, Ghana, Australia, and Cote d'Ivoire. Buy now and reap later. This is a very important slide. The largest company on the Nigerian Stock Exchange provide ease in execution of investment decisions. Stock price has shown a lot of resilience compared to peers. It's diversified. A major group in terms of the Dangote Group have their fertilizers, have their refinery, have their petrochemicals. And definitely, it will be the refining hub of West Africa and Central Africa. And if you add that to the aggregates and cement production, it gives you a very formidable and defensive stock. The upside potential target price of 173 naira, and while it's about 134 today, and 28% premium to the current price. African countries, post-COVID challenges for African countries and the Dangote source of competitive advantage. African countries are likely to embark on Keynesian countercyclical fiscal packages. Most of them will request for debt forbearance and interest standstill from lenders. They will seek additional support from the multilaterals, IMF, World Bank, Afrexim, and AFDB. They will increase spending on civil works, construction, and affordable housing. There will be interconnectivity of roads across countries because regional integration is not possible without infrastructure integration. So there's the Single Market Aviation Treaty for airlines so that you don't have what they call fifth freedom rights. So in other words, there'll be open skies agreement amongst African airlines. There'll be a trade agreement, and then there'll be the ECOWAS and WTO protocol, including the EPA. So all of this is suggest one thing: one, economies of scale, and two, it's only not for the faint-hearted.
Well, that was Mr. Bismarck Ruwani, the Chief Executive Officer of Financial Derivatives Company, presenting the facts behind the figures of Dangote Cement. And the World Bank's private sector arm, the IFC, has introduced new climate change conditions for its investments in commercial banks to encourage the lenders to wind down support for coal projects in Africa and Asia. The International Finance Corporation, which owns equity stakes in many large commercial banks in emerging markets, hopes the restrictions will trigger other investors to exit the coal sector. Under the new rules, in effect since July last year, but published in September 17, the IFC will no longer make equity investments in financial institutions that do not have a plan to phase out support for coal. The IFC will also use various conditions attached to its existing and new equity investments to ensure that the banks involved reduce their exposure to coal to zero by 2030. Climate change campaigners have welcomed the move, saying it sent a clear message to the commercial banking and insurance sectors that public finances will no longer be made available for institutions backing coal projects. And South Africa's central bank governor says additional interest rate cuts won't resolve the real problems holding back the country's economy. According to him, no amount of quantitative easing or the reduction of interest rates would produce the kind of skills the economy needs. Some politicians and labor unions have urged the central bank to do more to support an economy that the bank expects to contract by 8.2% this year, even after it slashed its key rate by 300 basis points. A lockdown that's been in place to varying extents for 6 months pushed the economy into its longest recession in 28 years, with an annualized drop in gross domestic product of 51% in the second quarter. And Libya's state oil company has reopened another port, the third to resume operation in less than a week, as a political truce takes hold in the OPEC members' devastating civil war. The National Oil Corporation is ending force majeure, a legal status protecting a party that can't fulfill a contract for reasons beyond its control, at Zweitina in eastern Libya after a significant improvement in security there. The NOC allowed exports to resume days earlier from the Hariga and Brega terminals. The three ports had been shut down since January as part of a wider blockade. The NOC said it's evaluating security at Libya's other export terminals as the country, with Africa's largest crude reserves, edges closer to reviving its battered oil industry. The company says production nationwide will more than double by next week to 260,000 barrels a day.